Hello everyone, welcome back. Welcome back to the chat room. My name is Ed Ponzi. It's great to be here with you today. Speaking to you on Wednesday morning from Southern California. It's beautiful out here. It's 6 a.m. So the sun's coming up out here. I love LA. What can I tell you? I love California. Anytime I see palm trees, I got to smile. What can I tell you? And it's just so beautiful out here. Nice to get away from the hot, sticky, humid east, if only for a few days. And we've got a lot of stuff to get to today. We've got a lot of questions, and we're going to make some moves for my stock people out there. We have a few moves to make. So let's get right into it. I'm starting out with INX, and you know, if you've been following along. Now I'm going to start out with the stocks here. Well, don't worry, we'll get to Forex soon enough. You know, if you've been following along with the stock portfolio, that I've been reducing the long side and adding to the short side. And you know, we gave the reasons for that. There were numerous reasons for that. But there may have been a few things that we didn't touch on that I perhaps should have. And one is, of course, the huge round number of 2,000 is looming up here on the S&P 500. Okay, that's you've got your bullish candle here, your break to new highs. Then you've got your inside day, a little consolidation, and a nice big drop down on Monday. And I think we're due for a pullback, and that's one of the reasons why I didn't want to be out over my skis long like we were. And so we got rid of some things. We got rid of, you know, Caterpillar and IBM and Dillard's and stuff like that. And we added shorts in Lululemon. We added shorts in TJ Maxx. And we're going to make a few more moves here because there's a few reasons why this could pull back more deeply. If you look at this, I just want you to look at the moving average here. This is the 150-day moving average on the S&P 500, and it's pretty much acted as support for the last year and a half, 2 years, roughly. You know, roughly, not exactly. It's not something I would trade off of, right? Because sometimes it goes below, sometimes it comes above. But one thing you'll notice if you look at this chart is that it gets extended. And when it gets extended pretty far away from that moving average, it tends to pull back. Now I'm going to pull up the data window here. Okay, and for example, here at the height, when this peaked, you had 1667 was the high of the index, and the moving average was 1495. So you take 16, it's 167, it's 170 something points. That's the farthest the S&P 500 over the last few years got above that moving average is about 170 points right here, and then there's a sharp pullback. Now you go here, right? Here the moving average is 1580, and your close is 1707. Here it's about 120 above the moving average, and it pulls back. Here, right, the close 1722, 1619. Here it's about 100 points above the moving average, and it pulls back. Here it gets out pretty far extended. This is about 135 points at its greatest peak above the 150-day moving average, and then a sharp pullback. In here, right, 1785, this is about 100, just a little more than 100 points above the moving average, and it pulls back. So you get the idea. When this gets somewhere above 100 points above the 150-day moving average, it has a tendency to pull back. And particularly, the farther it gets extended above the 150, the more likely it becomes to pull back. Now, as of the height here, the all-time high, which was Thursday of last week, you're at 1861 and 1985. So 125 points above this moving average. I'm not saying it's going to pull back to this moving average, but I am saying that it makes a pullback more likely on a technical basis. You just look at that chart, there's a pattern there. I mean, it doesn't just go straight up to the moon. Now, sometimes that does happen, and where the price just begins to run away. Why does that happen? It's because shorts get tired of shorting. They get tired of losing. They say that every time I short this darn market, I get pounded. It's not fun. And they grow tired of shorting it, and they say, you can't beat them, you join them. Now everybody wants to buy, and the thing goes parabolic. The market moves straight up, and that's the last thing that happens before it crashes, generally speaking. That's not what's happening here. But I think what's happening here is your other alternative, which is it pulls back toward that moving average. Maybe not all the way back to it, but let's just say a 100-point drop from that peak of 1985 is, say, 1885. 1885 is here. It would not surprise me to see us come down to here. Not all at once, not in a straight line. And it wouldn't violate the uptrend, interestingly enough, right? The uptrend would still be intact. Okay? And, so the most likely scenario, I guess what I'm saying is that a pullback seems to be in the offing. Now that's technical. And I'll give you a few more indicators. As of we got sell signals on, for example, RSI, which, look, if you sold on earlier sell signals, it wouldn't have worked out. Okay, I don't take that as that you should sell, but it was overbought as of just a few days ago, as was Commodity Channel Index, or CCI, as was Slow Stochastic Indicator. Should that come as a surprise? Not necessarily. All three of these are oscillators. They oscillate back and forth, and they all became overbought at the same time. So that's the technical scoop. You had overbought oscillators. You're very far extended above the moving average. What about the fundamental scoop on this? Because I'm going to type in something here. Let's go with S&P 500 price earnings ratio. Now, for my stock people, we've talked many times about the PE ratio, the price to earnings ratio. Whoops. The price to earnings ratio of the of an individual stock. But we haven't spoken much about the price to earnings ratio of not an individual stock. In other words, the whole market. So what if we go here? There's an article I wanted to show you. Let's see if I can find it here. And the point of the article, I can't seem to pull it up right now, but the point of the article is that the S&P 500, let me see if I can find it under forward PE ratio. See if that's specific enough. Yeah, this is it. You see, we are well above the 5-year average price earnings ratio. This is by Sam Rowe. So this is his article. And he's saying it's getting really hard to argue that stocks are cheap. And what I would say to this is another thing. You know that at one point not long ago, we were kind of turning against these high-valued stocks and buying low valuation stocks. And the low valuation stocks went up for the most part, but now they're not low valuation anymore. I mean, if a cheap stock goes up, is it still cheap? It's like anything else. If a pair of shoes is, $50 and then it's 75, is it still cheap? Maybe not so much, right? Maybe now it's fairly valued. So the forward PE ratio, and what is forward PE? Forward PE is based on the next 12 months' earnings, expected earnings, not the previous 12, but the next 12. The PE ratio, forward PE ratio of the entire market is 15.7. That's high. The 5-year average is 13.3. The 10-year average is 13.8, right? And so on a valuation, on a fundamental basis, you could say this market is now overvalued. I mean, and here we go into earnings season. And I believe I told you about Alcoa. Oh, Alcoa, by the way, bid higher this morning. Good earnings report. And it's kind of like we said, you know, Alcoa is becoming a better company in terms of they're closing their old, less profitable plants. They're opening newer plants that are more profitable. They're moving into areas of business that are more profitable. So this is still, you know, this is a good stock, but I don't like the market. So it makes it harder for me to like the stock because I'm worried about, now I'm beginning to worry about the overall market. We made good money. I don't want to give it back now. That's the key, right? I mean, if the market just keeps going higher, we're not going to give back what we made. But if it goes low, why? Because we're more long than short. We still have more longs than shorts. We're going to do something about that today, by the way. Right? I mean, yeah, we got rid of the cat. Man, I wish I'd kept it sometimes, you know. But, you know, we got rid of the cat because we had too many longs. We got rid of IBM because we had too many longs. We got rid of Dillard's, which was a big win for us. It's still going up, but we got rid of it because we had too many longs, and we just didn't want to be out over our skis. We trimmed Apple, which is still going up for us. We trimmed Amazon, which is not. Formed this inverted head and shoulders and sort of dumped yesterday. Not pretty. Okay, let me show you the volume here too. Your volume was, it's not like super high volume, but you got to remember you're coming out of a holiday weekend here. It's definitely the highest volume in several weeks. That's not good. So we're still long Amazon and Apple, but we're not as long as we were before. And we're still long Starbucks, which has been good to us. Starbucks has done nothing to go up for us, so it's kind of hard for me to worry about that one. And you know, I'm worried about everything really, but I'm not as worried about Starbucks as I am about. I don't want to give back the profits in our biotech names. We've done very well with Celgene, very well. But look at that move yesterday on high volume. Don't like that. We're still up. We're still up a good 7-8% on this. Let's get rid of it. Well, we're still up 7-8%. We're going to let that go. Celgene and ISIS. ISIS we bought on the double bottom breakout. It was doing good, doing good, doing good. Rolls over on us. We still have a little bit of a profit here. Let's take it. Let's take that money. So we're going to book profits on Celgene. We're going to book profits on ISIS. And we don't really have that many longs. JCPenney hasn't done anything for us, but I'm not worried about getting hurt like really badly in JCPenney because it's already pretty mashed down. I still think there's more upside than downside here. And I love the fact that everyone hates it. I love the fact that everyone hates JCPenney. No, it almost makes it easier to hold it, the fact that nobody likes it. Because you know what? If they have a decent earnings report, what's going to happen? All the analysts are going to come out of the woodwork and start upgrading it. Why? Because they've already all downgraded it. They already hate it, so they can't really do anything except change their mind. They've already made up their minds about this one. Technically, I like it. You know. Okay. All right. So let's continue on with this. So that's pretty much where we stand with the stocks. Like we're really, we're going to let go of Celgene, we're going to let go of ISIS because this pullback could be greater. Put the money in the pocket and walk away. I haven't been as active. Why? We're just coming out of a holiday week here. We're just coming out of a holiday, and it's a really slow time right now. So, don't be this guy or gal who's just itching to place the trade when there's nothing happening. Okay? We're taking some of these to cash them in because they've done well for us. And it really gives us a very balanced looking portfolio now. Half positions in Amazon and Apple, full position in Starbucks, full position in JCPenney. I hope I didn't forget anything. And we're short the Lulu. Shorting Lulu, I'll tell you, this thing came right up to its 50-day moving average, and it's starting to dip again. So we're actually back making money again on this short. Let me show you this. I'm going to change this moving average to the 50. Don't worry, Forex people. I'm getting to you in just a minute. Okay. It come right up to the 50, gapped up and gapped down. That's an island reversal. People got really excited about Lulu here in the short term, and it was moving up, and then they gapped it up, which I guess you could say is a novice gap. And then it gaps down the other direction. So you're on an island. If you bought it here, it's like you're stranded on this island going, oh, man, why did I buy this stupid Lulu? I mean, they make yoga pants. Anybody can make yoga pants. That's called a moat, right? If you're in a business that anyone can do, anyone else can just do what you do, oh, that company makes widgets. We have a factory. Let's make widgets. If everyone does that, hello, right? If everyone does that, then, the widgets are no longer special. So I say the yoga pants are no longer special, and I think this is going lower. I'm glad we're short that. TG Max has been a little bit irritating. We shorted it, and then this hammer forms. It goes up a little bit, but it doesn't really go anywhere. It's still just kind of sitting there. The one I'm thinking about covering is Target because this is now beginning to move up, and it's breaking this area too. In fact, let's do that because this is breaking this area. Former support should have acted as resistance. Here, I'll if you just mentally extend that line across, you can see we're above it. So let's get out of Target too. It's summer trading. It's doldrums. We don't need to be, we've got profit in Target. Why not? This is the opening bell. We've got profit in Target. Why not take it? Why not take it? So today is a profit-taking day on longs and shorts. Celgene, ISIS, and Target. I'm going to close them all. Okay. And really that leaves us with a very small portfolio, which is fine by me. Fine by me. Okay, let's start talking about Forex a little bit here. Really enjoyed that discussion. Let's talk about currencies a little bit. Let's get to some questions. What do you think of Kiwi pairs like New Zealand US dollar and New Zealand yen? They look good. New Zealand US dollar looks good. But you see this line I have drawn in? And I want to show you this too. Look, it's kind of funny. I didn't just draw that line in today. The price kind of went to that line and retreated a little bit. One of the things I was shy about with New Zealand is that there was a lot of nearby resistance. And this one goes back. I can't even get to it on the daily. I have to go weekly for you on New Zealand. There you see it. All right, that's kind of a big, so I don't want to be a buyer right at resistance. So let's just say two things could happen. If this thing breaks out and runs, maybe I'll buy the breakout or I'll just let it go because I haven't really had a good feel for Kiwi. And I think it's important if you're a trader to be able to say that about something. I mean, obviously we've had a really good feel for stocks. We've made money on most stocks. We've had a good feel for the euro. We made money on the euro on several occasions. I have not had a good feel for New Zealand, Aussie, and you have to be willing to admit that to yourself if you're a trader. You have to be willing to say, well, I'm probably not going to touch this one for now because I just don't seem to be able to get my arms around it. I liked it. I used to like the fundamentals, and it went down, and then, then it went up, and, I just don't want to go there yet. But what would get me interested would be a pullback or a breakout. Right here, no. Right here is a non-starter. But do you see how this area is acting as support? 87.40. That's big. So a pullback to 87.40, that might be enough to get me involved. And I do like, I do like it, but like I said, I wouldn't rush in. I'd probably wait and see what happened there and see if, okay, that's the way I'm looking at it right now. So if I realize I haven't had a good feel for something, here's how I'll play it. I'm not going to buy this if it goes down to where I think it's going to go. I'm just going to monitor it to see if it does what I think it's going to do. Because if it starts behaving the way I perceive it should behave, then maybe I'm getting back in my groove as far as Kiwi is concerned. But I want to see that first. Okay. All right. And what about New Zealand yen? Can I trade New Zealand yen the same as pound yen? We're still in pound yen, by the way. And yeah, the answer is yes. Let's set it up. First of all, we had a beautiful breakout, 5-year high on the pound yen. I'll make it the weekly so you can see it. The weekly, it's easier to get your head around this on the weekly. You can see the target. Target's not that far away, 177.50 target line. 169.50 is the stop. And then we have another target up in the 190 neighborhood. So if you look at the green level was our entry point, and that's around 173.50. We're kind of back there again. We're at 174. So we're up 50 pips on this. 50 pips is nothing in this currency pair. I mean, I realize it's slow going on this, especially in this market. I mean, we all know that the volatility is low. I'm not going to beat that dead horse. But there's your ATR. Oh, that's your weekly ATR. This thing moves 200 pips a week now. 200 pips a day used to be fairly normal for this. Now it's 200 a week. So what does that mean? It means you got to be more patient if you want to be a professional. Or, you could tighten everything up, but that, I think, is going to reduce your chances of success. If you start trading everything, look, the candles get smaller. That's going to force your stops and targets to be smaller, unless you're trading on a weekly time frame like we are on this one. Okay. But yeah, could you do the same thing with New Zealand was the question. So I still like this trade a lot. We're not, we're up 50 pips. We're not going anywhere with that. New Zealand I don't like as much as I gave a resistance, and just generally have not had much luck with this one lately. This is moving 130 pips a week, by the way. My goodness, that's pathetic. Anyway, 87.40, I'm going to pay attention to it and see if it acts as support. New Zealand yen, on the other hand, this does look kind of similar to pound yen. And the question really was, can I treat New Zealand yen like pound yen? Yes, you can. It's a carry trade. And don't forget, New Zealand was upgraded. I think it was Fitch upgraded the New Zealand economy, made positive comments about the direction they were heading in. So this looks to me like an ascending triangle that's been broken. So the price breaks through. Let's get rid of ATR. We don't want to confuse people. We're not talking about that anymore. Let's get rid of the moving average. We're not talking about that anymore. Don't want to confuse people. It's a lovely. You take all the indicators off the chart and you look at it. That is a lovely trend line, isn't it? Is it not? Did we not have something similar on pound yen? Maybe not as big. We could have, although we could have drawn it from down here. We could have said, well, actually, yes. But anyway, Beautiful chart. You break out, you break above resistance. It pulls back to the intersection of horizontal support and diagonal support and bounces out from there. So yeah, it looks good. It's basically the same trade, though, as pound yen. So here's the way I look at it. I'm already long pound yen, which means I'm short the yen. I cannot, therefore, go long New Zealand yen because that, to me, is not two separate trades. It's the same trade twice. Okay, and I don't want to be redundant. I don't want to place the same trade twice. But if you're not in pound yen, you could certainly trade New Zealand yen. Or you could trade a half-size position in both and combine it into one, like that. That's not usually what I do, but let's just say, for example, you hit the first target on pound yen, right? Now you have a half position. Why a half position? Because we have two targets on pound yen, right? So obviously we're going to close half at 177.50. Now, if I only have a half position left in pound yen, can I buy New Zealand yen? Yes, I can buy a half position. Okay. Or I could buy a half position in pound yen if the time is right, you know, if the situation allows it. But yeah, and that way I'm not loading the boat. I don't want my, you know, because if let's just say if everything starts trending against the yen, then most of the technical trades are going to be short yen trades. And it'll be very tempting to go, and I had it happen where someone said, hey, I'm long dollar yen, I'm long pound yen, and I'm long euro yen. Well, that's not a good idea because that's one trade. That's a basket trade. Okay. Here's another question about the COT report. Is the method of reading the report the same for both currencies and commodities? Well, let's take a look. And the answer is yes, at least as far as the way. Now, just keep this in mind. There's more than one way to read the COT report, and I treat you or impose upon you the way that I do it. Okay, I show you how I look at it. Other people may look at it differently. There's an old-fashioned, I consider it an old-fashioned way of looking at it. Well, while we're here, we might as well check it, right? There's the euro, right? So the way that we look at this is we would say, all right, big traders, right, non-commercial, 113 short versus 52 long. It's about 2 to 1 on the short side. So they're leaning short on euro, which makes it more likely that what happens, that it goes up. Why do I look at it that way? Because all these shorts, all these people, both long and short, are going to end these positions. None of them are going to stay in this position for the rest of their lives. These 52,000 longs are going to sell, and these 113,000 longs are going to buy. 113,000 shorts, I should say, are going to buy at some point, unless they're planning to spend the rest of their lives in the trade. So the more we stack up on one side, the more likely it becomes to reverse. This is not at a point where, this is not at a tipping point. This is not at a tipping point, but, and we've seen it much, we've seen that ratio much worse in the past. But I guess the question is, you know, would you look at other commodities the same way? I would, but just keep in mind, I'm not an expert on commodities per se. And for example, here's cheese, right? 76,000 shorts and 7,600 shorts, 3,800 longs on cheese. I'd look at that. I would look at that the same way. I would say, well, the markets, there's 7,600 short contracts they're going to have to cover at some point. But it's not a tipping point because it's only about a 2 to 1 ratio. But there may be other aspects of cheese that I'm not aware of. I don't understand the fundamentals of cheese at all, to be honest. I have no reason to, right? So I look at them the same way, but, and when it comes to gold especially, I mean, the question really revolved around gold. Gold really seems to have a mind of its own. Oh, hey, I forgot to mention we are long gold, GLD. Gold really does have a mind of its own. And I would consider it to be, there it is on the weekly. Nothing but green since we got in, right? So we'll take that. forgot to mention that. It hasn't really done anything since we got it. It's just kind of laying there. But I would not worry about it quite as much. Pardon. Oh, excuse me. That one snuck up on me. Anyway, just a quick sneeze, pardon me. Anyway, you know, I would not treat gold the same way mentally as I would treat any of these. I would treat it independently. And the fundamentals of gold are, frankly, bewildering. There are so many factors involved, but there's many, many things behind the scenes that you and I cannot really gauge. We don't really know what all the central banks are doing with gold. You know, they don't necessarily hedge in the futures market. You know, it's different. It's a different scenario. If I'm making, you know, random length lumber, I need to have, there has to be a futures contract because I need to know how much this darn lumber I'm going to get for it. If I'm a, you know, a lumberjack, I need to know what price I'm going to get when these trees come down. Or if I'm a farmer, I need to know how much I'm going to get for this cattle, right? I need to know the price, and that's why I have this futures market. What's different about lumber and especially food, cattle and cheese and pork bellies and all these things? What's different about them? They have a shorter lifespan. Crops like corn, wheat have a shorter lifespan. Gold does not have that shorter lifespan. So I would trust, and when it comes to commodities, I would trust the futures market and the COT report much more on issues such as corn than opposed to gold. Does that make sense? The futures market is really there for the farmers so that they'll know how much money they'll get. And they'll say, well, Farmer Brown knows I'm going to get X amount for my corn, and now he knows whether or not he can afford, you know, to buy a new tractor or a flat screen TV or a swimming pool or whatever it is Farmer Brown wants. Now he knows how much money he's going to get. That's why this market's here. That's why the futures pit's in Chicago, gang. Why is, you know, because that's where the crops are in the U.S. It's the Midwest. So why, you know, yeah, well, you know, there's a futures pit in New York, but generally it's not crops, right? What is that? The New York Mercantile Exchange, right, had oil and things of that nature, but not crops. So the futures are really more designed so that the farmer knows how much he's going to get for his crops. And I would therefore think it's more useful for those type of commodities. Okay, question here. Thanks for all the great stuff you're teaching me. I'm learning a lot. My question, say you want to trade euro, Aussie, or dollar yen. How would you use these individual currencies? Well, the question deals with Euro USD, which, and by the way, the first thing I would probably do with any of these is put them up on a chart with no indicators. And by the way, congratulations to everyone who made the 290 pips on our euro trade. I'm still smiling on that one. And there you can see where our stop was hit. Darn it. Anyway. I mean, I look at this now, and I mean, I just got out of this, so I'm not going to buy it again. But I might buy it where? Well, why did I buy it here? Because it was like at the intersection of horizontal and diagonal resistance. It could come back toward that intersection again. It could come back to this line, which is also a support level here, right? It would be like a horizontal support level from all these lows. If it comes back into that area and it catches that trend line, I might buy it. But at this point, I just got out. I'm still counting the money we made. And I don't like to rush back in because then it becomes emotional, right? I don't like to go diving back in because then it becomes an emotional issue or revenge issue for some of us. Aussie took my money, so I'm going to go get it all back. And then you get really creamed, right, because now you're emotional. So avoiding that is key. avoiding that emotional state. Aussie looks to me like there's a ton of resistance dead ahead here. There's massive resistance around 94 for Aussie. And it broke above, and this was a false breakout. Think about how bad this hurt. And this is, I mean, if you bought this breakout, because it makes sense. Doesn't it make sense to buy that breakout? Boom. Breaks out, hits 95. What a kick in the gut. The very next day, it gives it all back. Almost all of it, and then much more. That's a harsh thing to deal with. You know, like I said, New Zealand and Aussie right now, I just don't trust these, New Zealand and Aussie right now. I'm in the yen. He asked about dollar yen. The dollar yen is probably, I mean, I don't even have to pull up the chart. I know exactly what it looks like. It just keeps doing this, right, forever. And so I have no temptation to trade this whatsoever right now. If it breaks this line, which is 100.80, then I'd consider shorting it. And it's okay for me to short dollar yen because I'm long pound yen. It would not be. They're opposing positions. My pound yen position, I am short the yen. If I short dollar yen, I am long the yen against the dollar. That's a hedge. I can do that. If this breaks 1,000.80, I'll short it. But if that happens, the stock market's probably getting smacked pretty hard too. So it's a good thing, right? We're basically like 50-50 long short at this point. And any trades I enter from here out are probably going to be long short pairs. Okay, because you know, we're close to 50. We're not quite 50-50. We're close to 50-50. We just, you know, we've been taking the profits, man, and a few losses. We don't win on everything. Okay, so great question. So when I analyze these, I wouldn't just look at them against each other. I mean, you know, we didn't look at euro yen. If I'm looking at dollar yen, and I see there's nothing there, I might want to look at this. Oh, euro yen looks interesting though. If it breaks 138, could drop to 135.50. That's an interesting chart. So maybe if the yen does become strong, I stay long the pound yen, maybe I short the euro yen instead of the dollar yen. But the dollar yen also looks very interesting. The dollar's kind of aimless, isn't it? Does the dollar know which way it wants to go right now? Not really, huh? So I'm in no rush. I'm in no rush. You know, things reveal themselves in time. And until then, I just don't worry about it. Why don't you talk about the breakout on British pound? You mean this one where we were up like 250 pips? No, 150 pips on pound yen. Is it dollar weakness or the pound trade that stopped out? Oh, well, we got stopped out on a pound dollar trade a long time ago. See that red line? That's why you use a stop. Look at this. So, yeah, we shorted it on this false breakout. The stop gets hit, and then, boom, it goes up higher. You know, is it dollar weakness or is it pound strength? It's just, again, like I don't rush back in if I just got out. I just got out of pound dollar, and I don't like to jump back into the same pair right away because it becomes an emotional issue, whether you win or lose. I know that on some level, if I'm diving back into pound dollar, it's a revenge trade, or I need to watch out for that sort of thing. Everybody does. Okay, so the question is it just not fitting in with your overall position? It really is just, well, for one thing, I couldn't buy pound dollar. I couldn't buy cable because I'm already long the pound, right, against pound yen. So I don't want to double up and go long pound against the dollar and long pound against the yen. Is that two separate trades? No, that's one trade. It's a basket trade, right? And so I can't do that. And I don't want to short it again because I just shorted it and I lost money. So what does that leave? I can't buy it. I can't go long and I can't go short. I'm kind of out of options on this one. Ed Ponzi, you amaze me. Your overall portfolio exposure and how you hedge, the way you do it is still beyond me, but I understand the concept. Thank you very much. I appreciate your kind words, and it's very, very kind of you to say that. Always something new and so true in our classes. Thank you very much. Thank you very much for the kind remarks. Okay, listen, gang, don't be in a big hurry out there, whether you're on the Forex side or the stock side. Don't be in a big rush. The markets are awfully quiet. I would say the biggest potential risk right now is a sell-off in the stock market. If that happens, it would affect the yen. If the dollar yen or euro yen breaks down, you can be rest assured I'm looking to short one of them, and that'll hedge me against my pound yen position. Okay, and we'll try to make money on both sides, right? I'm not expecting things to get ugly, but listen, and you Forex people, I hope you paid attention to the stock portion when we talked about the S&P 500 being stretched like that. Why? Why? Because it correlates. The S&P 500 correlates with the yen. So if I'm paying attention to the S&P 500, I say, well, it looks like the S&P 500 might pull back. That's probably bad news for my pound yen trade. I'm not bailing out. It's a long-term trade with a very wide stop. I'm still up 50 pips. I was up 150. That was nicer. But I'm not worried about it. I'm not worried about it, but I'm paying attention. Okay? So think about that for my Forex peeps out there. Don't ignore what's happening in the stock market because it will affect the yen. And that has been displayed to us many, many times in the past. Okay? Thanks again for your kind words. I appreciate it. I will get back to you very soon. I apologize. We're a little bit late. We're running a little bit late this week because of the travel schedules. But we will get caught up with you, and we will fulfill our commitment to you. So you'll be hearing from me again very soon. All right? Send those questions in. Okay? info@edponzi.com, and I'll speak to you very soon. Take care.